Welcome back to Financial Market Insights for Traders. I'm Sophia, and today we're diving into a topic that sits right at the edge of opportunity and uncertainty: frontier markets investing. Now, this is one of those areas that tends to spark both excitement and hesitation. Some investors hear frontier markets and immediately think of untapped growth, early entry, and big upside potential. Others hear the same phrase and think volatility, political instability, and risk that's hard to measure. The truth is, both sides are right. And that's exactly what makes this space so interesting. Let's take our time with this and really unpack what frontier markets are, why investors are drawn to them, where the risks actually show up in real terms, and how you might approach them in a practical, grounded way. So, first, what exactly are frontier markets? Frontier markets sit just behind emerging markets in terms of development. These are economies that are still in earlier stages of growth. They often have functioning stock exchanges, but those exchanges tend to be smaller, less liquid, and not as widely accessed by global investors. You'll typically find frontier markets across parts of Africa, Eastern Europe, Asia, and the Middle East. These are countries where financial systems are developing, infrastructure is still being built out, and regulatory frameworks may not be as mature or as consistent as what you'd see in developed markets. And that lack of maturity is important because while it introduces risk, it's also where the opportunity comes from. In developed markets, a lot of growth is already priced in. Information is widely available, markets are efficient, and competition is intense. In frontier markets, that's not always the case. There are gaps, inefficiencies, and areas that haven't been fully explored yet. Now, let's talk about why investors are actually interested in frontier markets investing for long-term growth. At its core, this is about timing. Investors are trying to identify economies that are on the path to becoming the next emerging markets. They're looking for early signals of growth before those markets attract widespread global attention. One of the biggest drivers here is early stage economic expansion. In many frontier economies, key sectors are just beginning to scale. Think about banking, for example. In some of these countries, a large portion of the population may not yet have access to formal financial services. As banking infrastructure develops, that opens the door for rapid growth across lending, payments, and consumer finance. The same applies to technology. Mobile adoption, internet access, and digital services are often expanding quickly, sometimes leapfrogging traditional infrastructure entirely. This ties into a broader theme: structural economic shifts. Many frontier markets are transitioning from agriculture-based economies into more diversified systems that include manufacturing and services. That transition tends to drive productivity gains, job creation, and rising income levels. And this is where a high-risk, high-reward frontier market strategy starts to make sense. Investors aren't just chasing short-term price movements. They're positioning themselves for long-term structural change. Another factor that often gets overlooked is diversification. When people think about global markets, they tend to focus on the major players: the US, Europe, China. But frontier markets don't always move in sync with those economies. That's why some investors look at the diversification benefits of frontier markets investing. Because these markets can be driven more by local factors, like domestic policy changes or regional trade dynamics, they can behave differently during global market shifts. Used carefully, that can help spread risk across a broader portfolio. But now we need to shift gears and talk about the other side of the equation. Because the risks here are not small, and they're not theoretical. Let's start with political and governance risk. In frontier markets, political environments can be less stable. Elections can lead to major policy shifts. Governments may change rules around foreign investment, taxation, or capital movement with relatively short notice. In some cases, capital controls can be introduced, limiting your ability to move money in or out of a country. That's not something most investors in developed markets ever have to think about, but here it's a real consideration. Then there's liquidity. This is one of the biggest practical challenges in frontier markets. Trading volumes can be low, which means that even small transactions can move prices significantly. From a real-world perspective, this creates two issues. First, you might not always be able to buy at the price you want. And second, and more importantly, you might not be able to sell when you want to. During periods of market stress, liquidity can dry up quickly. And that's a key reason why discussions around risks of investing in frontier markets, explained, tend to focus so heavily on this point. Next is currency risk. Even if an investment performs well in local terms, currency movements can change the outcome entirely. If the local currency weakens against the euro or dollar, your returns can shrink or even disappear. Inflation also plays a role here. Some frontier economies experience higher inflation, which can affect both consumers and businesses and ultimately impact investment performance. And then there's the issue of information. Reliable data isn't always easy to find. Financial reporting standards can vary, and analyst coverage is often limited. That makes it harder to evaluate companies and increases the level of uncertainty. So, when you put all of this together, it becomes clear that frontier markets are not just emerging markets with higher returns. They're a different category altogether, with their own set of dynamics. Now, in terms of how investors actually access these markets, most people don't invest directly. Instead, they use mutual funds, ETFs, or global funds that include exposure to frontier economies. This approach provides diversification and professional management, which can help navigate some of the complexities we've just talked about. And this is where technology has started to make a real difference. Modern platforms have made it easier than ever to explore global markets, including frontier regions that were previously difficult to access. If you're looking for a world-class, cutting-edge, user-friendly trading platform app, it's worth taking a look at crystalbellmarkets.com/platform. It's designed to simplify the process while still giving you access to a wide range of markets. And when you're dealing with something as complex as frontier markets, having a platform that's intuitive and reliable really matters. If you're serious about expanding your investment approach, that's a solid place to start. Now, before you even think about investing, there's something else that matters just as much, and that's education. A lot of people approach frontier markets investing for beginners with enthusiasm, but not always with enough context. These markets are heavily influenced by macroeconomic trends, global capital flows, and regional developments. So building a strong foundation is essential. If you're looking for a way to learn in a more practical, accessible format, I'd recommend checking out this podcast at rss.com/podcast/crystalbellmarkets. It covers trading, investing, and macroeconomic insights in a way that's easy to follow. It's especially useful if you want to understand how different parts of the global financial system connect and where frontier markets fit into that bigger picture. So let's bring this all together and talk about strategy. If you're considering frontier markets, the first thing to understand is that this should not be a core allocation for most investors. Typically, it's a smaller, satellite position within a broader portfolio. That way, you're limiting your downside while still giving yourself exposure to potential upside. The second point is time horizon. These are not short-term trades. Volatility is part of the experience. Investors who succeed here tend to take a longer-term view and stay patient through market cycles. Diversification is also key. Rather than focusing on a single country, spreading exposure across multiple frontier markets can help reduce the impact of country-specific risks. And finally, staying informed is critical. Conditions can change quickly, so keeping up with political, economic, and global developments is not optional. It's part of the process. Before we wrap up, it's also worth briefly comparing frontier markets to emerging markets. Emerging markets like China, India, or Brazil already have larger, more established financial systems. They attract significant global investment and tend to offer more liquidity. Frontier markets are earlier in that journey. That means higher potential growth, but also higher risk and lower participation from global investors. In many cases, today's frontier markets could become tomorrow's emerging markets. And that transition is where a lot of the long-term opportunity comes from. So, are frontier markets high risk or high reward? The honest answer is both. And the more important question is whether you're prepared to deal with both sides of that equation. Because frontier markets investing is not about chasing quick wins. It's about understanding complexity, managing risk, and positioning yourself for long-term change. If you take the time to learn, stay disciplined, and use the right tools, there is real potential here. But it has to be approached with clarity, not hype. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia, and as always, stay informed, stay disciplined, and I'll see you in the next one.